In today's video, I'm going to show you the ICT method that I use to trade, and I'm also going to show you how I mark up my chart to make sure that I'm getting the best possible outcome for every single trade that I take. First things first, the way I am getting my bias for the day is by going to the daily time frame. First, I have a look at it to see where price is. I mark out everything that I think is valuable for me to determine the bias for the day. So today, when I had a look at my chart earlier, I saw that there was a new day opening gap. So I decided to mark out that new day opening gap because I thought that that could be valuable. Every time that there is a new day opening gap or there is a new week opening gap, I mark it out because I know that it will come in handy whether that day or weeks from now. I know that that's a great target, a great liquidity target every single time. So I mark out my fair value gaps and I mark out the new day opening gaps or the new week opening gaps. After that, I go to the 4-hour time frame where also I mark out the 4-hour fair value gap. After that, I go down to the 1-hour time frame and I do the same exact thing. I mark out the 1-hour fair value gaps in a way that I know that it's valuable for me, because I'm either marking it out as a target or I'm marking it out as a place where price could bounce up from. After that, I go down to the 1-minute time frame and I mark out things like equal highs and equal lows as well. The reason why I'm doing that is because my targets are equal highs and equal lows. And after that, I like to target new day opening gaps and new week opening gaps as well. So today there was a new day opening gap, which was part of my targeted liquidity. I actually start looking at the chart about 15 to 20 minutes before the New York Open. What does that mean? It means that I sit down around 10 past 9 or quarter past 9 and I just have a look. I mark out all the things that I said previously, are the fair value gaps from the daily, 4-hour, and hourly time frame, as well as if I feel like there is anything that's valuable for me on time frames, such as the 15 minutes or 5 minutes or 3 minutes, I will mark it out. Not every single day or time, but if I feel like on that specific day that fair value gap is valuable for me, then I will mark it out. The other thing that I like to do as well is I start marking out the opening range gap. Obviously, the opening range gap will be completed when New York opens. So the opening range gap ranges from the previous day's 4:14 close to the current session's 9:30 open. For that to be able to have a look at that, we need to swap the sessions on TradingView. So the way I like to do it is in the right-hand corner. There is next to the clock, there is a section where you can have a look at the sessions. Usually it's on the electronic trading hours, but if you swap over to regular trading hours, then you can see exactly how the gap looks like. I also like to leave it like that. And the reason why is because if I swap over back to the electronic trading hours, I feel like that could sway my bias and I don't want that to happen. So while I'm waiting for the first presented fair value gap to present itself, I'm doing nothing. I'm just watching price action and I'm just sitting on my hands. That's all I'm doing. As soon as the first presented fair value gap appears, I mark it out, because sometimes price moves so quick that when you mark it out, the next candle can, like today, for example, the next candle can come and just slightly tap back into it and then drop from there. In today's instance, we dropped lower. My original bias for the day before the first presented fair value gap appeared was that we could potentially drop back down to the new day opening gap. The new day opening gap is a high probability liquidity area, so I like to target that, like I said previously. So today, when the first presented fair value gap appeared, which was the 9:41 a.m. candle, I marked it out quickly, and then the next candle already just tapped into it and dropped. When I saw the 9:44 candle, how big it was, how the momentum just made it drop, I realized that we could possibly just go lower from there. So I was looking for even more opportunities to go short. I ended up going short today, and I actually made a nice profit. With this method, what I realized is that price can be quite volatile around this area, around the first presented fair value gap. And what happens is that when price quickly moves away from the gap, that sets the tone for the rest of the day as well. So in today's case, we have this fair value gap at the quite higher point of the Nasdaq, and price dropped from there, and it hasn't returned for the rest of the day. That means when things like that happen, that's a great indication for me to just continuously look for short opportunities. I'm not even gonna think about longing anything here. What I'm gonna be looking at is where is the opportunity where I can actually go short from there. If you stop trading, I usually stop trading around 11 a.m. And if I feel like I want to continue or I wasn't able to get into any trade during the morning session, I'll just have a look and come back around 2 p.m., just a little bit before 2 p.m., and have a look again at the chart. Because what happens is that if we are this bearish like we were today, where price just doesn't want to go up higher after a certain point, then I'm just going to look for short opportunities because the probabilities are higher for that to work out than for me to look for some kind of a dodgy long opportunity. The same way it happened today, just after 2 p.m., price quickly took out some liquidity, and then it went over a nice big fair value gap, closed below it, like this, and then it just kept dropping. Also, it helped if anyone wanted to take a short like that. Obviously, it helped that there was an equal low at liquidity target, obviously. So what you could have done is you could have entered on a short as soon as the candle closed. You took a short from there, and even if you targeted the equal low, that would have been 15 points already, which is great. It's very quick, very good. But if you wanted to hold longer, you could have done that as well. You could have had around 40, 50 points too. So that's quite good for an afternoon session. And to be honest, that means that you are literally trading with the trend and trading in the direction of the trend as well, which is always going to give you a higher probability chance of the trades working out than if you were trying to trade against it. The reason why I picked up this strategy from ICT is because this has given me something that other strategies have not been able to, and that is a stability with my psychology. I am not over trading. I don't feel like there are multiple opportunities presenting itself. I know for a fact that if I am not able to get into the opportunity of a short or a long on around that first presented fair value gap, after that I would need to maybe look for another opportunity, but there won't be anything much more for me from there because I just won't allow myself to trade. because what I keep focusing on is that one single fair value gap, the first presented fair value gap. If you have not seen my previous video, then spoiler alert, I have made $670 in 29 seconds. This is usually the case when I'm trading this first presented fair value gap. And the reason why is because the volatility is quite high when it comes to this area, especially the first half an hour. The first half an hour of the trading session is very, very vital. If you want to look for great opportunities for quick trades, quick movements, high and dynamic movements, then obviously you need to look for those type of trades in the first half an hour. But like I said, for me, this first presented fair value gap, this area, it's like a gold mine. I know for a fact if price taps into it, I know exactly what I'm looking for. There are days when price just keeps moving in a direction, but nothing is happening. And then what I'm looking at is it just the wicks that are being left behind, or is it the body as well that's taking over this fair value gap? If the body is not taking over, but it's just the wicks, I know for a fact we are gonna drop. So this method gives me a sense of direction, which is very, very high probability. And it also gives me the opportunity to know when to enter a trade. And I also know that if price just keeps trying to go back to that area, and if I enter a long or short from there, that the chances of it working out and not taking me out is quite high. And therefore, I won't be over trading. I won't feel like I will continuously need to look for a new opportunity as well. So what ICT also says about this opening range gap is that 70% of the time, price will seek the 50% of the opening range gap. If you, for example, entered here on the first presented fair value gap, just after it actually formed, and you decided to short it, your target could have been an equal low that I marked out here, and it could have also been the middle range of the opening gap. If you're new and you feel like you're lost between all the other ICT methods, I would highly recommend that you have a look at this. You should go and check out ICT's videos about it because, like I said, the credit is all his. This is not on my... I didn't come up with this idea, so I would suggest that you go back to the source itself. But like I said, this has helped me greatly. My trading psychology has gotten 100 times better. I'm much more calmer. My screen time have gone down significantly as well, purely because I'm only focusing on one single thing. And if it's not there, I'm either waiting, sitting on my hands, or after a while, I just say goodbye. If you feel like this video has helped you in any way, shape, or form, or you just feel intrigued about this method, then please subscribe, like, and leave a comment below. I would love to know what your thoughts are on this. Thank you very much, and see you in the next one.